me where you're going to school, and your interest in business, just really quickly.
Yes, sir. So I'm Toshio Kobayashi. I go to Canadian International School of Tokyo. I'm really interested in investment banking and investment management, or asset management. And yeah, Adam, you want to take it over?
Hi, my name is Adam Platek. I go to the American School in Japan, and I'm really, sorry about that. I'm really interested in entrepreneurship and marketing and management.
Okay.
My name is McKay Jenkins. I go to the American School of Japan as well, and I'm really interested in finance.
Hi, my name is Stella. I go to the American School in Japan, and I'm interested in marketing.
My name is Yokumura. I go to St. Mary's International School in Tokyo, and I'm also interested in marketing.
Okay, thank you. I think that's everyone. Yeah, my two sons went to ASIJ. They graduated in 2012 and 2016, so probably a little bit before your time. Let me share. Let me figure out if I can share the screen here. And host is disabled, participant screen sharing. Toshia, can you allow me to share my screen? And you're on mute.
Yes, I'm working on it, sir. Give me one
Okay.
second. My apologies.
That way I can drive the presentation. That'll make just things a little bit smoother, I think.
Should me and I should do an introduction as well during this time?
Yeah, that's good. That's
so I'm Ying Chi. I used to go to Hawaii Preparatory Academy with Toshi. Now I'm actually a freshman in Georgetown University, McDonough Business School. And so for everybody else that's listening, my position will soon be handed off to one of you guys. So please apply. And I'm interested in consulting and somewhere between operational or management consulting. And I'll hand it to Aisha.
Hi, my name is Aisha Rakyan. I also go to the American School in Japan, and I'm interested in marketing and management.
Okay.
Mr. Nichols, you should be able to share it, sir.
Okay. Let me see. I have to do something too. All right. Oh, Toshia, I would have to quit Zoom and come back in. So why don't you just pull it up on your screen and we'll just go from there.
Okay.
Yep. If you can put that, there we go. You go to the next slide. Okay. Here's me looking a little bit more formal. I am currently an executive advisor at Ernst Young Parthenon, which is it's the strategic consulting department of Ernst Young. So, and I'm focused on the financial services industry. Let's go to the next slide. And so today we'll quickly go through my background, and then just very quickly, I wanted to focus on sort of the fundamentals of investing, and then we'll talk about the investment management industry, the current state, and the challenges for the future, and then Q&A. But if you guys have questions during the talk, I'm very comfortable if you just want to break in and ask as we go. Either way, it's fine with me. Let's go to the next slide. And next slide. Okay, so here's me by the numbers. I have had about 28 years in the finance industry in New York. Well, I'll get to all the details there. I have worked in a number of different sectors in the finance industry. I was for broker dealers, asset managers, and asset servicing or trust bank. So some of the notable positions I've had is I've been president of State Street Global Markets Japan, which my main task there was to shut that company down and move the business into the trust bank. I was the deputy president of State Street Trust and Banking. Before that, I was the CEO of Invesco Asset Management. And before that, I was the CEO of Morgan Stanley Investment Management Japan. And then prior to that, I was executive director and vice president. So all in all, I've spent about, I guess it's about 24 years or 23 or 24 years in Japan with spending some time in Los Angeles, getting my MBA, and working in New York in between. I've been involved in the American Chamber of Commerce in Japan. I'm the Investment Management Committee chairperson, the International Bankers Association of Japan, and also very, very involved in the Boy Scouts of America. I'm the Far East Council president, and that's where I met Toshiya. I've got one wife, 2 sons, 1 dog. She's 17 years old. I have my MBA from UCLA, from the Anderson Graduate School of Management, and I got my BA from University of Washington. And my hobby is photography, mostly film photography. I have over 20 cameras. I need to get rid of a few, I think. Okay, let's go to the next slide. So that's me in picture, or in by the numbers. Let's go in pictures. So here's a recent photo of me, but let's go to the next slide. Let's talk about where I came from. So in my youth, I did all the normal things. I played in some bands. There's actually I was not a very good musician, so they made me the manager of the band. And then I funded my college by working in Alaska on fish processing ships. Let's go to the next slide. And then I grew up, got a little older, and when I lived in New York, I was part of the volunteer firefighters department in Scarsdale, New York. And the other picture is in 2011 up in Tohoku, helping out with the recovery. Next slide. Okay, so now and then I got respectable. So here's me with one of my cameras, large format, and then in a business environment a couple of years ago when I had hair. So that's me. So that's my background. Let's go to the next slide. Okay, building blocks for investing. So what we thought I would talk about is I'm sure as you guys are all interested in business and investing, and most people when they start talking about investing, the first thing they talk about is what should I invest in? But what I wanted to do first is just talk about sort of the theoretical, what is it, what actually is a stock and what actually is a bond. I'm not going to talk about what you should invest in or how prices work in the market, because I think there's a lot of stuff online that you can look at to get that information, and I'm certainly not an expert in that. But one thing I would recommend if you're interested in figuring out how markets work, how pricing works, and things like that, if you listen to the podcast called Planet Money, and they've got a series called Planet Money Summer School, which was focused on investing, and it's a really good way to explain how the markets work, better than I can explain. So if you're interested in that, I would highly recommend the Planet Money's Summer School. You can just Google that and listen to that podcast. It's about 4 or 5 15-minute podcasts. So let's go to the next slide. Okay, so there are when you talk about the financial markets, and I'm assuming that we're all not real experts here, but when you think about the finance markets, there are simple concepts and products like buying a stock or buying a bond or putting your money in savings accounts. And there are complex concepts and products like derivatives and swaps and futures and forwards. But at the end of the day, all complex products and all complex concepts and products are really created by adding simple products and concepts together. So fundamentally, financial products are about buying a slice of a company's income stream. So when you think about when some financial whiz comes and talks to you about derivatives or swaps, if you want to understand what it is, you can always replicate a complex financial instrument by simply borrowing money and buying or selling stocks or bonds, and then you can build up to what the complexities are. So let's start out with just basically what you're buying, the very basics. So let's go to the next slide. So let's just talk about basic profitability. Let's say you've got a great idea. You want to start a company, and so you've saved up a little bit of money from working at McDonald's, and you invest. You buy the equipment. Say you're going to manufacture something. You buy the equipment. You rent an office, and you begin to produce. So at the very beginning, you're going to have a loss because you've got some fixed costs that you need to invest in, and you need to cover your costs. And then you've got some variable costs, which would be the cost of your goods. So if you're selling, say, a new computer, it costs you $50 to make, and you sell it for $200. So your variable cost is going to be $50. So, but as you build your business and start selling things, you start bringing in revenue, and you start making profits. So as soon as you cover your fixed costs, you're breaking even, and if you cover your variable costs, you start making some profits. So, and all of those profits go to you. It's a very simple model, right? You invest a little bit, and you start making something and selling it, and you make profits. So that's easy. So let's go to the next slide. So let's add another little bit of complexity to it. Let's say that now you're going to issue bonds, let's say, or essentially borrow money from a bank or borrow money from your parents. So that means that you're going to subsidize your startup, but when you borrow money, you're going to have to pay interest on it. So you're going to have to pay interest, and so you really don't make profits until you paid off all your interest. But after that, all of the profits are yours. So, and the bondholders, the people that are lending you money, they can't lose any more than what they've loaned you already. They're gonna get what the return from the bond, the interest rate that you're paying back. But after that, they're not going to share in your profits. So let's go to the next slide. So now you decide, I'm going to invest in my own money. I'm going to issue bonds, but I'm also going to share the upside. So I'm going to issue stocks. So what you're doing there is you talk to your good friend Toshi and say, look, I got this great business idea, and it's going to make boatloads of money. I just need you to invest. And he says, well, what do I get for that? And you say, well, after we pay off the bondholders, I'll give you, say you're going to buy 50% of the company, I'm going to give you 50% of the profits. And he says, okay, that sounds like a good idea. So you're going to, instead of you keeping all the profits, you're going to have to share your profits with everyone else. So that means that the upside potential that you have is you're sharing it with other people. But the flip side of that is that your investors are going to get nothing until the company makes profits. So when you're buying a one share of stock, you're buying part of a company, and part of the future profits is really what you're buying. So so theoretically, and this doesn't really sometimes work in the real world, when you're buying a stock, you're buying a part of the company, you're buying part of the future earnings. And so you should be able to figure out, okay, if I've got one share and that equals 1% of the company, you can figure out what the expectation is of the future earnings. You can do a net present value analysis, and you can back into what the company is worth. And theoretically that should work. Oftentimes the stock price is different from what the theoretical value is, and that's where financial markets get really interesting, and people can spend all of their time winning or losing money. So let's go to the next slide. So I wanted to just talk a little bit about why equity markets exist. So if you've got a great idea that's just going to make boatloads of money, why would you ever want to issue shares and share your profits? You ideally, the only thing you'd want to do is maybe issue some bonds, but you would want to take all of the upside potential. So equity markets, the reason that people want to issue equity is it gives company founders access to capital, meaning maybe banks won't loan you money, but some venture capital, private equity firms will for a share of equity. So if that's the only way to get the capital you need, you might want to do that. The other way would be to get a valuation of a company. So if you issue stocks, let's say you issue stocks worth 20% of your company, and then you get an instant valuation of what that other 80% is worth. And there you can probably leverage that to get more different financing. But the other reason is, let's say you've built a great company and it's humming along really well, and you're tired and you want to retire. So you issue stock to cash out. Now for equity buyers, why would they want it? They want a chance to participate in the upside. So if they see a great company and they really believe in it, and they think that it's going to have long-term profitability, they don't want to only issue pay for debt. They want to participate in the upside. The other thing is, if you own one company, you're really dependent on that company succeeding or failing, and so that's a zero-sum game. But if you buy 10 or 20 companies, or parts of 10 or 20 companies, and say 3 of them fail but 17 of them do well, you're going to diversify your risk. So that's a really good thing to do, and that's at the end of the day, that's the origin of joint stock companies. Does anyone know what the first joint stock companies were? You guys are all on mute. Does anyone know? Raise your hand if you know. The first joint stock companies were out of the Netherlands. They were when ships went to go search for goods in the New World. It's a risky venture. If that ship goes out and sinks, then the owner loses all the money. So the first joint stock companies were they would gather enough people to invest in a ship. It would go out, and if it came back and they all shared in the profits. So you could invest in 10 or so ships, and maybe 3 of them would come back, and so you'd do pretty well investing wise. But those were the first joint stock companies. And then the final reason is sometimes the stock certificates are pretty cool. Disney has a really interesting stock certificate if you want to take a look at it. And a lot of times in Japan, companies issue like little presents for stockholders. Some of the food companies will send you some of their food samples if you own stocks, which is it's kind of fun. Let's go to the next slide. Okay, so current state of investment management industry. Before we talk about investment management, let me spend a little bit of time talking about the difference between investment banking and investment management. So investment banking is the stuff that always gets in the news and in popular press. But investment banking are the people that will help a company go public, will help a company issue debt or further equity, and buy and sell securities. And so their business is really a transaction business. If they make a deal one day, they're going to make a lot of money. If they don't make a deal, they're not going to make a lot of money. They're sort of the hunter-gatherers in the finance society. Now, investment management, they're really the farmers in the financial industry. An investment manager goes out and he talks to people, the asset owners, and says, hey, I can do a good job investing for you if you just give me your money, and I'll charge you let's say 1% of your assets. And if it makes money, your assets will increase and I'll charge you 1%. If I lose money the next year, I'll still charge you 1%, but it'll be less because your assets will decrease. So this seems like it's an annuity business, and it takes a long time to build up. In order to build up that business, you need to have trust and build up a good reputation. So you can't do that overnight. And I've seen a lot of investment bankers try to become investment managers, and most of them don't have the temperament for doing that. They don't have the patience. But with asset management or investment management, it's a long, slow process, and it depends on building the credibility and the expertise over time. So you can have your best year revenue-wise and make some very short-term decisions that will kill your business in the future, and you really won't know it for a couple of years. So investment management is a lot less exciting on the surface because it, like I said, it's just a long-term. It's a cultivating business rather than a hunter-gatherer business. I've attended some recruiting sessions where people come up to me when I was in with investment management. People would come up to me and tell me they're very interested in investment banking, and I would give them the 2-minute talk about the difference between investment banking and investment management. And most of the time, 90% of the time, they would go see the investment bankers, and they weren't interested in me, which was okay. Let's go to the next slide. So I pulled some, these aren't showing up very well, but I pulled some slides off the internet on the asset management industry. And globally, we've seen, and particularly in 2020, we saw double-digit asset management growth and healthy flows. So global asset management is $103 trillion. That's how much is invested in the market. And there have been big inflows into the market over in the recent past. So it's a huge market. And let's say an asset manager is going to make maybe on average about 0.5% or so on those assets. So if you take $103 trillion times 0.5%, that's pretty good fees that are coming into the market, or the asset managers are making. So let's go to the next slide. So here's just a little bit of a breakout of the asset management industry globally. It's very much dominated by North America. About half of it is coming from North America, and most of that from the United States. So 48.6 trillion. Europe comes in next at 25 or 26 trillion. Japan and Australia they're about 50-50, about 8.5 trillion. So say about 4.5 each. Latin America is 1.8, Middle East and Africa 1.4, and then Asia, excluding Japan and Australia, is around 14, and that would be Singapore, China, Taiwan, and those areas. So you can see that the asset management industry is really dominated by the US and Europe, but Japan is a significant player as well. So that's how it looks globally. Let's go to the next slide. So assets had double-digit increases in growth, which is great, but profitability only increased 1%. And this is because although revenues increased, expenses increased at a higher rate. So that is a little bit profitable, or a little bit of a problem. So AUM increase, average assets under management increased, net revenues increased, but the costs also increased, which means the profit pool went down. Now this is a problem in the industry, as fees are on a downward trend, and processing expenses are going up, which of course squeezes the profit margins. Let's go to the next slide. So, and this really sort of talks about that, is that cost measures have not offset fee pressures. So profit margins have been flat. Some of the major asset managers, profits have gone up pretty well, but for most of the others, not so much. So the asset management industry is facing margin pressures globally and needs to address that. Let's go to the next slide. Okay, before we get into the challenges for the future, I want to stop here and let's talk about, let me hear your questions about investment management, anything about the investment management, the industry, anything we've covered, how things work, whatever you want, because I haven't presented to high school students all that much, so I'm not sure what you guys know. Does anyone want to come off mute and yeah.
I have a question.
Yes.
What is your advice for aspiring high school students, aspiring people who want to work in the industry of investment management in high school, to get an internship in this industry?
That's a good question. And for high school, it's going to be a little bit more difficult, because when in asset management and most of the finance industry, when they're looking for the reason they do internships is because they're looking for people they want to hire, and you're really going to need a college education to get hired in the finance industry. So high school interns are not so interesting for a core asset management firm. So let me answer it in two ways. In college, which you're going to be in a few years, but also in high school. In high school, what I would do would be to focus on distributors, so securities companies, banks, people that are selling mutual funds or selling investments. They do need just hands or office work to help them get things done, to do presentations. And what that will do would be to get you exposure to part of the the client focused side of the industry. And so doing that, I would just go to local offices or family connections and just figure out where you can do anything in a local sort of distribution office. That way you can start to understand some of the products, what is being sold to investors, and just sort of the basic block and tackle of how the industry works or what they're trying to sell. Once you get into college, there are the recruiters come on campus to look for summer internship positions, and to make yourself attractive there, having a basic knowledge of the finance industry, meaning join an investment club, and just take some courses on the economics and basic finance, and really you just need to show an interest about why the finance industry is interesting for you. So that would be my recommendations.
Hi, I also had a question. So I know you mentioned college. So what majors or areas of study do you think would be best for someone looking for a career in investment management?
That's a great question, because one of the big functions in investment management is to become a portfolio manager, which means the guy that actually makes the investment decisions. And I've actually looked at this a lot because I've been asked a lot, and I've been wondered what career, what background, how do you become a portfolio manager? And I really don't have a great answer. I know a guy that has a very successful investment manager who got his undergraduate and graduate degrees in Russian literature. So I mean, a lot of people that want to get in the industry, not necessarily be portfolio managers, would do sort of a business major focusing on finance. But a lot of others, what's going to make you successful in investment management, particularly if you're going to be an asset manager, is understanding another business or sector that you're investing in. So for undergrad, I would say major in what's really interesting to you. So if it's engineering or some sort of social sciences like economics or psychology, do that and understand the industries that are involved with that, and then go back and get an MBA to put the business sort of cap on it. But you'll be a more diversified, you'll have a more diversified background in academic work and academic if you don't focus on business in undergrad. Now, if you love business and you understand that's what you love, then go ahead and major in business or accounting or whatever. But try to build as diverse background as you can, and then you're not going to apply for a job as a portfolio manager. You've got to sort of build a path to where you want to be. And this is true for any career that you do. If you know what you want to do, you're not going to get there right away. You're going to have to build a path, meaning find a job that gets you closer to where you are, closer to where you want to be than where you are. So maybe you get a job at a securities firm, and then in a couple of years you move to an asset manager in the risk management department or the operations department, and then you get to know people and get to understand opportunities and gradually work your way to where you want to be. And I think that's, and whether it's in one company or multiple companies, but I think that's probably the best way for you to manage your career.
Additionally,
Yeah.
I was wondering, what key skill, technically and not technically, do people in the investment management industry look for while hiring? Like a skill that someone possesses individually and also technically that they look for.
Okay. Another good question. Technically, you want someone that understands financial statements and financial analysis really well. So you need to be able to understand basic accounting. I have to tell you, one of my least favorite courses in college and in my MBA program were accounting classes, but they were some of the most useful in my business life. So you need to be able to understand financial statements. You need to understand basic economics and finance, and then more and more, depending on what you do in the company, having some very good technical skills like understanding programming, advanced spreadsheet skills are going to be really useful. Presentation, depending on your job, presentation skills, so PowerPoint is going to be very useful. So that would be on the technical side. On the sort of the individual or the soft skills side, you need and this is not unique to investment management, is you need to do whatever you can to raise your, what they call the EQ, your emotional quotient. You need to be able to understand and relate to people. You need to be able to communicate to people, both individually and large groups. You need to understand how to manage your superiors, manage the people underneath you, and collaborate with your colleagues. So you really need to have that that ability to the interpersonal skills. I was, Einstein is known for his scientific accomplishments. Who knows if he was the smartest scientist, but he was the one that could communicate best. Okay, let's move on to challenges for the future. So let's go to the next slide. So we talked about fee compression or things that are impacting the asset management industry. Here's a slide that is just showing some of the different pressures that are on the asset management industry in the even pre-COVID. So there's been traditionally there's a person would work for a company, and the company would give him a pension plan, what we call a defined benefit plan. So you work for 30 years, and then when you retire, the company guarantees a certain payout every month, and that's your pension, and that's how you're going to live when you retire. That hasn't been working really well for companies. As the number of workers decrease and the number of retirees increase, because lifespans are increasing, there's less money for companies to be able to pay for those plans. So the solution has been to say, okay, you're really not going to have a defined benefit pension plan anymore. Instead, we're going to give you money that you can invest on your own, which is good. But it just means that if you don't invest wisely, you'll lose all your money. You won't have much left for retirement. So, but the way that 20 years ago, the industry really focused on trying to manage the assets of pension plans. And now, as money moves out of pension plans to individuals, the industry has to move towards managing assets for retail investors, for you and me. So, and one of the things that's happening there is as you and I are investing more of our money, we're getting more picky about what we want to pay for, and we want good value before we give money to asset managers. So one of the best ways that we can measure that is look at, how much the asset manager is charging us. So investors want cheaper products. The asset managers can't charge too much, and they have to deliver value. So that's squeezing profit margins, because asset managers need to really make sure they're delivering value and at a good price. There's been and one other aspect of investing is there's been an ongoing debate that theoretically, if you study finance, one of the first things your finance professor will tell you is you can't beat the markets, meaning You're not smarter than everyone else, so you're not gonna, your individual investing is not gonna beat the markets over the long term. So people have started saying, okay, if that's true, then why would I pay for a mutual fund manager to try and make bets when in the long term, I could just buy the market, I could just buy a market index. And so a lot of money has moved to the market indexes, which are very cheap, and it's very hard for an asset manager to make profits on those. So that's further impacting the profitability of asset managers. And let's see here. The other thing that's happening is there are thousands of asset management firms. Some of them are huge, some of them are mid, and some of them are small. The bigger asset managers are able to get efficiencies of scales, and so their assets are growing quite a bit. And if the smaller firms are sort of boutique firms that offer a special service or a special skill, and they're doing pretty well. But the firms in the middle are getting really squeezed. They're losing assets. They're not able to do efficient operations, and so their profitability is just really under pressure. So a lot of them are merging or being bought, and what's happening is it's a winner take all environment, meaning the good funds are getting all the money, the mediocre funds are getting almost no money. So, you know, when you're at school, if you of course everyone wants to get an A, but a B or a C is okay, you still pass. Well, in the asset management industry, it's either A or F. You're either succeeding or failing. And then there, you know, in the last 10 years, there's been a lot of change in the asset management industry where the financial regulators have been really concerned about making sure the asset managers are doing a good job and not taking money from clients. So there's been a lot of pressure from regulators to do a better job. And there's been a lot of opportunities for automation, meaning let's not write down in a ledger book when someone buys or sells something. Let's do it all on a system. Let's do it electronically, and let's reduce the number of human interventions in our business. So that's forcing asset managers that they need to invest in technology. Long term, it should reduce costs, but short term, it costs a lot of money to develop systems. Let's go to the next slide. So this is a slide that we put together that I derived from my company. So what a consultant does, and I think someone here said they were interested in consulting. So what we do as consultants is we talk to companies about their industry and how things are going well, but especially where the challenges are. We talk about where the problems are, and then we say, hey, we're here as a consultant to help you. So hire us and we'll solve all your problems for you. So this is how we're recommending that we can help our clients solve problems. We need to make sure, so reorient the business around the client. So what this means is we need to make sure, asset managers need to make sure that they are meeting the client's needs and not just putting out a fancy new product, but actually putting out a product that the client needs. We need to continue on, asset managers need to continue to become more digital, less labor intensive. We need to reimagine the investment proposition. So I'm sure you guys have all heard of cryptocurrency and big data and artificial intelligence. All of these things are new technology that portfolio managers need to use to generate superior returns. So there's a lot of tools available to asset managers that weren't available 10 years ago that can help them when they're investing. Asset managers need to maximize their growth areas. They need to look for new products. So again, cryptocurrency, investing in new markets, investing in ESG. ESG stands for environmental, social, and governance. So these are the investments that help the world, in addition to making money. Asset managers need to transform their business models, meaning if they have inefficient operations, they have to figure out how to make those operations more efficient. And they need to leverage inorganic growth opportunities. This means that asset managers should look at buying and selling different companies. So rather than try to build a system, maybe they should buy a company that already owns a system that they want. If they want to get access to Europe, and rather than build their own sales offices, buy a company that already has sales offices. So this is what asset managers need to think about, so they can do it more quickly. So what we think the future of asset management is it's going to be exciting. It's going to consolidate, and it's going to be exciting for the firms that really adjust to clients' needs and make sure that they that they're becoming as efficient as possible and take advantage of all the technology tools that are available to them. Let's see, let's go to the next slide. Okay, and that brings us really to the end of my presentation. And apologies if I did not get the level right, but I'm open for any questions that you guys might have about anything we've talked about or things we haven't.
Please don't be shy, and if you have a question, you can raise your hand or you can just speak out from start.
Okay, I had a question, Mr. Nichols. How does a large multinational company like Ernst & Young remain agile? And how is important that agility versus sticking to what has traditionally worked in the past?
Thanks for that question. I think the head office at EY is asking that same question. It is really difficult. In Japan, in Japan alone, EY has about 8,000 people. Globally, I think there's about 300,000 people. So it really, to make changes, it really is like steering a big ship. It takes a long time, and senior management can't be on the ground and see what's going on everywhere else. So the key is setting a strong vision for where we want to be and how we need to change. And then they need to do a couple things. They need to hire the right people that are bought into that vision, or make sure that people are bought into that vision. And they need to set up compensation and organization structure that supports moving towards that vision. So, for instance, if you're saying we really want to do cross-border business, we want our America office to cooperate with the Japan office to serve our multinational clients. Well, you need to make sure that that a partner in Japan has an economic incentive that is going to get paid for working with the American office, and that the organization is set up so that they can easily cooperate together without undue barriers. And are we there yet? Probably not. But you know, it's the vision that EY has to do that. That would be one example. But once the messaging is set, that's not done. The management needs to continually emphasize the message and where we want to go. Talk about success stories. Talk about really celebrate where we've had successes, and really demonstrate to the entire firm that we're serious about the changes we want to make. But it is really difficult to change a huge company like that.
I also had a question for you. So I know that a lot of the work you do might be able to be online, but how did the pandemic and the lockdown kind of affect EY?
Yeah, so I have been in the office about 3 times this year, literally. consulting is a little bit unique in that ideally we should be out at our clients' locations and not in EY's offices for most of our business. So we've been working remotely. We've been carrying around laptops for years. So the change for us wasn't that difficult. What makes it more difficult though is we're just missing we're losing a little bit of connectivity within the company. We don't have an area where we can go and meet together and compare ideas and just get things done, have our hallway discussions. So, you know, we've done pretty well with it because of the nature of the business, but longer term, there's going to have to be a balance of where we have opportunities to get in front of each other, not just on screen. That's sort of a medium long-term worry that we have.
Yeah, I have a question too.
Okay.
With this being such a lot of people in this business and it's really saturated stuff, how do you really separate yourself from other candidates when it comes to like job interviews or something like that?
Yeah, that's probably the best advice I could give would be networking. And this is what I wish I knew when I was in college and didn't do the networking. And now I'm sure you've all heard the buzzword about networking, which you know, but what you want to do is you want to go to industry events. You want to take advantage of your friends' fathers that are in industry, fathers and mothers that are in interesting businesses that you're interested in. And you don't call them up and say, hey, do you have a job for me? You send them a note saying, hey, I'm interested in your business. Can you tell me about it? And you go and you just get to know people. And probably the way things usually happen is you'll have a nice meeting, you'll send your thank you note, and nothing will happen. And then maybe 6 months later, there'll be an opening for a job or something where they'll say, oh, I talked to this nice kid 6 months ago. They might be the right person. The other thing is, you know, as you go, when you get on campus, you'll be doing, there'll be on campus way where you can apply for entry-level jobs. You should do that. But if you've already got if you've networked or you know some people in that company, you should contact them and say, hey, I think, you know, thank you for the interview we had 6 months ago. I'm interested in this entry-level job. Give them the job rec number and all that stuff. And just wanted to let you know I'm pursuing that. What will happen is if you don't do that, your resume goes into a pile. HR kind of looks through and shifts through, and they give each resume 10 seconds worth of a look and decide which ones they want. So it's really hard to stand out there. But if a manager calls up HR and says, hey, there's an interesting candidate that's in your pile somewhere, you go to the top of the pile. Right. So that's the way, that's probably one of the only ways that you can get through the standard application process is try to get a network and try to get a manager at that company to ping HR about your resume. And just the fact that someone pinged your resume, you get a little note on it and you'll get towards the top. When I was at Morgan Stanley as a manager in New York, every year we get summer interns, and we knew that all of the interns we got were really friends and family of some senior manager. And at that time I worked in the operations department, so we figured out that we weren't getting really important senior managers, but we were getting some senior managers. So we always tried to figure out where they came from. So it's sort of the way things work inside the company. So you applying from outside, you need to try and get a little bit of a friend inside that'll help you.
What would you say are the most common mistakes a company makes when they first expand internationally or acquire other companies outside of its borders?
The first and yeah, there's a lot of ways to make mistakes. There was
Or the
one
most common.
Yeah, there was one EY partner Ernst & Young partner. He told me, look, my job is I help Japanese companies acquire companies outside of the US, and when that doesn't work out, I help them fix it or sell them. So the biggest mistake companies make when they expand into a new market is to assume that what worked in their local market is going to work in the foreign market. So for an example, Vanguard is a well-known mutual fund company in the United States that has been really successful with their distribution model. They've done nothing in Japan and are essentially closing down in Japan because they were unwilling to adopt their distribution model for Japan, and that didn't work. When outside of finance, Wendy's is another example. I think they've tried to come into Japan 3 times. And now finally they've got probably the best chance where they're looking at someone who's really taking charge and making sure that it's adapting itself for the Japanese market. But yeah, assuming what works where you're successful in a new market, that's a big mistake. Now, on buying a company, a lot of companies, they talk about mergers or acquisitions. I don't really believe at the end of the day there's anything that mergers exist when companies come in as equals. I think in almost all cases someone is being acquired, and the acquiring company needs to recognize that and not just they need to break some eggs and be willing to do integration very quickly. I've been through some very good integrations that were very tough for the people being acquired, but it was better for the investors. And I've been through some where people danced around the question of whether it was a merger or an acquisition, and it just made the company dysfunctional. So I have a question from Ita. What is the difference between asset management in Europe and Asia in terms of client and investment types? It really comes down to the maturity of the market. So Europe is a much more mature market with an established middle class. So you have a lot more retail investors that are investing in retail mutual funds. And the institutional investors, like the pension funds, are very sophisticated. They invest, they're willing to take risks and understand what they're investing in. In Asia, and this would be excluding Japan and Australia, it's much less developed. So you have very wealthy individuals that are investing a lot, and you have some governments that are investing a lot, but they're not really sophisticated. But the middle class is not developed so as much, so it is harder to get retail investors to invest, and it's just starting now. It's going to be interesting, but the opportunities for revenue from retail are just not quite there as they are in Europe and the US.
Yeah, quick question. With the rise of the ETF and index funds, what jobs do you think will be affected or even eliminated in the future, and how should people looking to join the finance industry approach and think about that?
Ooh, that's a great question. Yeah, ETFs are gonna put a lot of pressure on margins for asset management companies. So it's really gonna threaten traditional asset managers. There's other things going on in the financial markets like fractional shares and things like that have some people writing about, people won't need mutual funds anymore. And I think that will be true, but I think people investing in finance will still need expert advice. So That won't go away. The way it's going to be delivered, though, will change. So a lot of it will become online. Operations are going to be more streamlined. Trading is going to be streamlined. So getting involved in the infrastructure of an asset manager is going to be more and more difficult. There's going to be less and less jobs, but they're going to be more technology intensive. So understanding technology and actual practical applications in the finance industry would be a really good path to follow. You'll end up being a disruptor in the finance industry, and you want to be a disruptor rather than a disruptee. So looking at fintech and what's going on in fintech is a good way to focus on the future of the finance industry, I think.
We have a question from Caleb. Caleb, go ahead.
Hello, I'm Caleb Bandelli. I'm in the JEC Chicago. I was wondering, does EY have any initiatives in place to attract younger investors, maybe high schoolers or college students?
So EY as a consulting firm would not. Finance firms do recognize that they need to train young investors so that while you don't have much money now, in the future you will. So if you train them and get them loyal now, it will pay benefits in the future. The issue with really young investors, and I would call it, high school, college, and young adults, is one of the problems with distribution is if an account is small, it's really hard to make money for the distributor to make money off it. So everyone is trying to figure out the right mix of getting people early enough in their life to start investing with them, but to be profitable at doing that. So, at the high school level, it's really mostly going to be aimed at sort of educating people rather than trying to get you to invest your assets or that you really don't have a lot of at this point.
I have a question. What has been your biggest challenge working in a foreign setting?
It has been becoming comfortable with ambiguity. So I talked a little bit about when a firm goes into another country, they need to give up their assumptions. It's the same thing with individuals. You need to be able to put all your assumptions and your unconscious biases at the door and learn how to accept that you're not going to know everything, or everything's not going to be the same as it was in your home market. And once you've figured that out, it makes you much more valuable in any situation if you're comfortable dealing with ambiguity. But that's really the biggest challenge, is making sure you're comfortable with dealing with ambiguity and understanding that you don't know everything.
Quick question. Where's a good baseline to start pursuing my economic interests as someone with very little knowledge?
I would, can we go back a couple slides? There's, I mentioned the Planet Money podcast. That's an interesting one. So find podcasts and things that are interesting for you. But if we can go back a couple slides on I listed, there's if you look at if you're really interested in investing and how people do it, looking at Warren Buffett's the Berkshire Hathaway annual report, it's always really informative. He talks about why he's investing and what he's investing in. The classic book on investing. Oh, that page. Oh, back again. Back. A little bit more, almost there. There we go, right here. So looking at Benjamin Graham's book on investing, that's what Warren Buffett said he learned from. learning how to read the management discussions on a company's 10K would be a really good thing to do. But I think you're asking even a more basic question of just how to start. And I think finding a good podcast that explains things basically is a really good thing to do. I wouldn't focus on things like Motley Crue or Motley Fool, the people that are talking about what you should invest in now, because they have their points of view and they're not going to really get you to understand the fundamentals. Does that help?
Yeah, it does. Thank you so much.
I have a quick question.
Yeah.
How do we as high schoolers begin networking in this industry? And what do you think of LinkedIn as a networking tool?
LinkedIn's interesting, and it's a good tool to figure out who's connected to who. But at the high school level, the people that are going to be most willing to spend time with you are people who understand high schoolers. And so I think a good source for you guys, particularly in Japan, particularly at ASIJ, is your friends' parents. Because you're getting a really, at ASIJ and St. Mary's and all the international schools, you're getting a really concentrated group of expat executives. So you can get access to people that are that are powerful in Japan and are going to be powerful in the US, and they understand high school kids better than someone who does someone who doesn't. Someone else might be a little bit more reluctant because they're going to say, well, it's going to be 4 or 5 years before I can hire these people. So I try to figure out people that are going to be able to relate to you, and I do think it's the parents of your friends.
Thank you.
And maybe so teachers probably can help too, because they've got some connections.
Yeah, I want to ask your opinion on cryptocurrency. Since you can't do any DCFs or any evaluations to find its real value, how do you think it relates to an investment choice like a stock or a cryptocurrency? Because you can perform those evaluations on stocks, but not cryptocurrencies.
Yeah. I invested $300 into cryptocurrency. Now it's worth $900. I'm not sure why. Yeah, you're right. I think at least right now it is very speculative. It's more gambling than anything else. So I think, and this is part of the process. I think the ultimate vision is that cryptocurrencies become an alternative to regular currency. And for that to happen, the volatility, the speculative nature will need to go down. But for that to happen, you're going to have a lot of people on both sides of the trade. So a lot of speculators getting together and driving the uncertainty out of the market. So so that's kind of what happened in the stock market, is that they're efficient markets. No one really has a significant advantage over anyone else, so that you're going to get fair pricing based on the market. And that hasn't happened yet with crypto. And eventually it will. I'm not sure when, how far away, and how much money people will win and lose before we get there. So yeah, you're right. It's right now, I think it's very speculative. It's sort of fun to make guesses on the way it's going to go, but I would never put anything material into that market at this point. My retirement savings are not going there.
I think we want to does anyone have 1 or 2 more questions? I think we're going to cut it there after.
I have a quick question. Do you think taking a course or learning more about technology will raise chances of getting hired? As you mentioned before, skills in PowerPoint presentations, etc., are really useful.
Yes, particularly in entry level, your first jobs out of high school and college, the more you know about, so sort of the office suite of products, um, presentations, spreadsheets, database languages, and really what you're trying to learn there is not just how to do a presentation. You're trying to learn the fundamentals of what goes into a presentation or what goes into a database, because over the course of your career, the systems you use are going to change. So you want to understand the fundamentals of it so that you can go into a new, so let's say you learn the fundamentals of Microsoft Access and you learn about databases. That's not, you go to another firm or another place and they have a different database program. If you know the fundamentals of a database, then it's just it's much easier to learn a new program. So when I started out on spreadsheet programs on Lotus, and over the time I had to move to Excel. So, but when I moved to Excel, it was pretty easy because I could say, I know that a spreadsheet program can do this. I just have to figure out how Excel does this. So you already know what it can do. You just have to figure out the mechanics of it. And it's going to be it's the same with database and most technology. So friends of mine that are much more knowledgeable than me on technology say, learn a computer language. It doesn't matter which one you learn, but learn a computer language, because the logic is the same for all languages. It'll be once you know the logic of a computer language, you'll be able to transfer that to other languages. And one thing's pretty certain, you're going to have to over the course of your career.
Thank you.
Does anyone else have any questions that you would like to ask Mr. Nichols before we wrap this up? If not, we have actually one question. What is the biggest challenge or mistakes that you have faced, and how did you overcome or respond to it? And what did you learn after that event?
That's one of the toughest interview questions. Yeah, so I think probably, and this didn't happen till probably later in my career, is negotiating through ethical decision making. So in the course of your career, you're going to come across decisions that you need to make that involve ethics and what is the right thing to do. And a lot of times doing the right thing is not enough. You have to do the right thing, but you also need to get along with your coworkers. You need to make sure that people understand the way you're doing it, so you've got to balance a lot of factors, and sometimes the ethical decisions are not very clear. You've really got to work through a lot of different situations, and there is no right answer. So the way you deal with that is you ask yourself a bunch of questions. One, you ask yourself, is this against the law? Is it in the long-term interest of the business? Am I valuing my needs over the client's needs? What would it look like if this became public and got in the newspaper? So you ask those kind of questions, but you don't stop by just asking yourself. You talk to a lot of people and get their perspectives, and so you can come up with a lot of different opinions. Some of them you might not agree with, but at least you'll hear them. And then once you've made a decision, you think about what the downside implications are going to be, and if you can mitigate those. But then also you set up, you want to be very transparent to everyone around you about why you're making a decision. And so I've had a few of those throughout my career that have been, when I was going through them, Sometimes I did it in a structured approach, and those went really well. Sometimes where you can make mistakes is jumping to a conclusion early without getting all the facts. So be aware of when you're faced with an ethical decision and have a framework for how you're going to deal with it and get a lot of input is probably the best way to manage that as best as possible.
Mr. Nichols, would it be possible for you to post your email on the chat? So for anyone who didn't ask a question or might have a question later, they can ask you basically at any time.
Yeah. There
Thank you,
we
Mr.
go.
Nichols.
Very
Okay.
easy email.
So, so for the participants, thank you very much for joining to our session tonight, or this morning. Our next event will be on September 18th. It will be the same time. It will be with Mr. Stefan Karpin. Oops, my apologies. He is the worldwide and country manager for Visa Japan, and then the registration link will be on our website. And yeah, so thank you very much for your time and participating. Mr. Nichols, thank you very much for coming. And yeah, thank you very much for the participants. So if the participants could leave.
One second.
Sorry, before we end the call, we would like to have a group picture. So if the participants can turn their camera on.
So this picture would go on our website, so it would be. Okay. Thank you for those of you who turned your camera on. We really appreciate it. Yeah.
Yeah, thank you very much. So yeah, if you could leave, we have some other stuff to take care of on our end. So we would hopefully see you in our next session.
Thanks.